Good morning, ladies and gentlemen. We start this week's review again with volatility because we think volatility is still the key indicator of what is ahead for the market in the short term. This is a weekly chart, and as you can see, the market closed on Friday at the absolute lows of volatility for the week and is breaking the below the 16 level, which is such an important trigger level in volatility. Over the next few weeks, we think volatility will do a U, much like it did in this period, or this period, or this period, and will trade somewhere between 14 and 12%, which will probably be the low of this cycle before doing a further leg up sometime. Well, the average is about 8 to 10 weeks between volatility events if you count the bars. So we are likely in for a period of rising stock prices and also rising bond prices, as the correlation between the two has been exceedingly high since the beginning of this year. And the fall in volatility has been reflected in the market close on Friday. If we try to now enlarge this part of the chart, we will see that the market closed above the 50-day. Again, it is comfortably above the 200, and it is now pointing towards a move up to 2,800, which is where the first important gap lies, around 2,805. No doubt that over the course of the next few days the market will try and fill that gap and trade in a range of approximately 2720 up to 2810 or so. That is what can be expected. We have the MACD turning positive again on the dailies, and we will also look at the weeklies, but a move up to 2800 really is on the cards for next week. If we look at a weekly chart, much the same picture. The market just has this last hurdle to overcome, which it will be around 27.55, so right where the market will open more or less. After that, the coast is clear for a move to about 2800, which will be the 0.786 retracement of this whole move down, and we think the market is going to have great difficulty in breaking that level. So somewhere between 2780 and 2800 is going to be the toughest part of next week. The first part should be easy. The move up to at least 75 should be early and quick. If we look at the leader, and that's NQ, it has already broken up through the 0.786. It is now in a fantastic position to trade up towards the highs, maybe take them out by a few ticks. So really a move above 7,000 in the early part of next week should not surprise at all, and that is when we expect the market to actually start feeling it and not being able to take out the highs by much more than 50-60 ticks before probably retracing all the way back down. So we have a certainly a market which needs probably a new high before we can say that more consolidation will be in order. NQ is still the leader. We still like it far more than the S&Ps. Stick with it. It's a winning position. As far as the other markets are concerned, DAX is probably going to retest the 12,750 level, which is the upper band of this channel, and also the 200-day moving average. So 12,750 should be your target for next week. If we see it, you have to get out. It's not good risk reward to be long above 12,750. The equivalent level for the stocks is around 3,535. That is a full 80 to 90 points from here. That's 3%. Should be a nice move. If you see 3,530 or so, you really have to be out and say thank you very much indeed for a nice ride, but we don't want to know anymore. This is probably the market that will suffer hardest during the next leg down if we see it. Things are heating up in the Nikkei as well. A nice move up towards 22,800, 22,900 is probably the most we can expect. If we have a look at the Fibonacci retracements, we will see why that is so. We have the 0.618 together with the 50-day moving average at 22,800. That is where you let it go, especially against NQ. We think that Nikkei and the Europeans, once they've reached their upside targets, will probably struggle far more than something like XLK or the Nikkei or the NQ, and will have far more downside than the NQ or XLK. The correlation between the way TLT has traded and the stock market is actually not that surprising when you think about what's been happening in risk parity land and how everybody has been bailing out of their positions. Now we are having a bit of a rally back in the bonds. People have sold all their holdings. Bonds are at very, very interesting levels. As you can see, this has been the bottom for a very, very long time in bonds. This is the TLT, i.e. in long bonds. It'll take a while to break this level and close decidedly through it, in which case a move back up towards 120, 121 really should not surprise, and that should coincide with a rally back up in equities. Once this move is over, probably the move in equities will be over and they'll both turn down lower and retest the lower levels. But for the time being, we think more than a few ticks rally in bonds, which has been the norm for the past few weeks. There is more room for them to rally to the upside, and that will buoy up and support equities. What to say about foreign exchange? Well, we've been more or less right. The dollar is regaining some stability. We are probably going to come back down towards 121.70, 80 and retest at least the 50-day moving average. We might make it even to these levels around just above 120 over the course of the next week. But we have the 200-day moving average inexorably rising, and in a couple of weeks it's going to be somewhere around 119. That is probably as far down as we can see the euro go for the time being. And if we have a look at a chart of DX, that will match with a level somewhere around here, which will be 92 to 92.50, or even up to 93. So the highest you can really expect is between 92 and 93 for the next few weeks and months. We try to get everything to match our view, and this is a chart of the weekly gold. You will see this band of moving averages, which is basically between 13, let's call it 1304, going down towards 1295. That is probably the area that you can expect gold to get to before doing a slingshot higher again, we hope. Certainly that is the area that we'd be targeting to buy some serious position. So around 1300, which should coincide with the stock market being quite a bit higher, 2 or 3%, with European markets being higher by about 2 or 3%, and also by the dollar being lower by 1 to 2%. I know some of you are also interested in European fixed income, and this is a chart of the bubble, really short-term chart, only going back to October, November, when this became the front month. It is quite likely that we trade in this area between 131.45 and 131.15. If you remember, this was the level we stopped at and traded between 131.50 and 131.75 before all speculation about how quick QE would end in Europe, and all the speculation about Draghi being forced to do it slightly quicker. And then we broke down and continued lower. We now have quite a few trap shorts here, having broken the 130.80 level. A lot of shorts below here. It is not unreasonable that over the course of the next few days we go all the way up to 131.45. If we do so, we'll have the 200 period moving average in our favor as well. As close as possible to 131.45 should be a very decent short for a return to at least this 130.80 area at some stage over the next few weeks. And finally, a couple of words about our bugbear, the BTP. We will stay short of it forever because we think it fundamentally has to move. But as you can see, it has lost all impulsion, really, until it takes out this low, which we keep on saying is around 135.20 on a closing basis. There is no hope of an acceleration. This level has been defended probably by the ECB for a long time now. It has lost all impulsion on the downside, but also on the upside. So really BTPs are now only being traded on a spread to the bunds. Bunds are positive, BTPs are doing nothing to going down, so that spread is widening out. But on the other hand, it could easily come back in. So we don't really feel that it's the right time to trade the BTPs aggressively. There will be plenty of time to short them if something bad happens in Italy, because we're so far away from fundamentally justified levels. If something bad happens in Italy, this market is going to 125. It is not going to 134 or 133. Therefore, you're going to have plenty of time to sell it the morning that something bad happens. We don't feel like anticipating it because for the sake of 100 tick on a 1,000 tick move, it's just not worth the pain and the aggravation of watching it trade in a 50 tick range for the next month. Not worth the margin, not worth the personal aggravation. Wait for it to break and then jump all over it. Well, the biases for next week, we are still sellers of rallies, but now the rallies are going to be more than the very few ticks we've had in the past few weeks. We've sold vol. We're quite happy with being short of vol. The market is only in retracement mode. It's certainly not in an expansion mode, and therefore volatility should keep on going down, and theta should kill those positions very nicely. We showed you where we think the bond, the TLT, will go around 121-ish at most. That is where we think it's reasonable to resell. Bund and bubble, we gave you the level 131.40-ish is where we want to sell that. As we said last week, and we've changed this, above 27.60, which we'll think we'll see early next week, 2800-ish gap fill. We got this one absolutely right. Wish we'd stuck with it. 2700, 2680 should hold. 2620 is the line in the sand. Certainly we didn't see it go below that level. That level was very well supported. The fact that it was gives us confidence that they'll take out 2760 and give us the 2800 gap fill. NQ is still the opportunity. It's still the one that's going to make new highs way before SPX ever does. And VX has actually shown us the way. It's now below 1650, indicating more stability and more ratcheting upwards. DX, look for 92, 93. That's as much as you can hope for. And then when he gets there, option spreads to the downside. Very much XLK, short SPY, long EM. That spread keeps on moving, and it will keep on moving for the next couple of years, we're sure. Thank you very much indeed, and speak to you Monday.